While your savings account earned 0.38% last year, the Federal Reserve quietly finalized a rule that freed $219 billion in capital for the 8 largest banks in America. Not as a loan, not as a bailout, as a regulatory gift buried in a technical adjustment to a leverage ratio most people have never heard of. Inflation ran at 2.7% over the same period, which means the average American saver lost roughly 3 cents of purchasing power on every dollar they held, while JPMorgan, Goldman Sachs, and 6 other Wall Street giants received the largest single capital release in modern U.S. banking history. The Federal Reserve called this reform capital neutral. The banks called it a regulatory tailwind. Goldman Sachs quietly tied it to expanded buyback capacity. Nobody called it what it actually is. By the end of this video, you will understand the exact mechanism that transfers wealth from ordinary savers to institutional balance sheets, why Fed Chair Kevin Warsh inherited this system, and why this decision affects the cost of capital from Mumbai to Milan. You're watching Voice on Pages, where capital logic replaces capital noise. Subscribe if you think in systems. To really grasp the scale of the shift, we need to examine the mechanics of the old framework. For years, global systemically important banks, the massive institutions that anchor our financial system, were required to hold a strict 6% Tier 1 capital buffer at their depository subsidiaries. That baseline acted as a hard floor. It was a blunt, uncompromising regulatory instrument designed specifically to prevent catastrophic overleverage by forcing these banks to keep a significant portion of their balance sheet locked safely away. Now, look at what happens under the new rule taking effect in April 2026. It drops that required threshold down to roughly 4%. Mechanically, that unlocks significant incremental capacity across those 8 giant institutions. In fact, independent calculations show this recalibration creates over $384 billion in total excess Tier 1 capacity. Regulators calmly describe this as simply making the backstop no longer binding, but the math tells a much more profound story. If that sounds a bit abstract, think of it like a landlord cutting your required escrow deposit from 6 months down to 4. You didn't suddenly get a raise, and you didn't get richer in the traditional sense, but instantly you have 2 months of capital freed up. You now have the flexibility to deploy those funds elsewhere, fundamentally changing your immediate financial posture. So what is the actual motivation here? If you read the official documentation carefully, the underlying goal becomes entirely transparent. Regulators explicitly state they want to reduce disincentives for these banks to engage in U.S. Treasury intermediation. The timing of this isn't random. It is a matter of pure structural necessity driven by the sovereign debt market. Right now, there is a vast refinancing wall looming over the market. It's $9 trillion in size, and it desperately needs institutional buyers. Research from the Brookings Institution points out that this specific regulatory shift creates up to $700 billion in additional capacity to absorb that exact debt. By lowering capital requirements, the central bank is quietly engineering the very buyer demand the Treasury needs to function. Wall Street analysts, of course, are looking at the exact same data but drawing distinctly different conclusions for their clients. While officials frame this as a mere operational adjustment, financial analysts are explicitly calling out widening envelopes for share repurchases and strategic dividends. The capital might be intended to absorb government debt, but the newfound flexibility allows for some very shareholder-friendly deployments of those funds. The founder of Voice on Pages, Nitin Tyagi, wrote "Stop being busy" after realizing the most damaging losses in his business were structural, quiet, running underneath while he stayed busy reacting to daily emergencies. Financial repression works the same way. The extraction runs in tenths of a percent while the headline number looks fine. This structural rewiring wasn't a sudden pivot. It was firmly set in motion well before the current central bank leadership even assumed control. If you map out the timeline of how these regulations are finalized, the deep institutional nature of the change is obvious. It operates completely independently of the traditional political cycle, moving silently in the background while public attention is focused elsewhere. When Kevin Warsh was sworn in as Fed chair in May of 2026, he inherited a system that was already rewired. This recalibration was actually finalized months prior, in November of 2025, and it was pushed through despite clear internal regulatory dissent from former Vice Chair Barr, a dissent that officially confirmed the precise scale of this Tier 1 capital reduction. A systemic maneuver like this inevitably raises questions about structural vulnerability. During hearings, Senator Warren directly questioned if this easing heightens the risk of bank failures. But that question remains without a formal, on-the-record answer. The hard reality of global finance is that capital doesn't follow safety. It follows logic over loyalty, moving wherever the regulatory environment allows for the most efficient return. That relentless search for yield does not stop at the American border. When you alter the leverage constraints on the world's largest dollar clearinghouses, the consequences immediately ripple out into international markets. The mechanics of this domestic capital shift end up creating very real, measurable frictions for foreign economies. As American banks are freed up to absorb domestic debt, global institutions like the BIS and the IMF note that this mechanically compresses capital flows for higher-yielding emerging market assets. We are witnessing a stark divergence in international monetary policy because of it. For instance, the Reserve Bank of India is moving in the exact opposite direction, holding system-wide capital adequacy ratios tight at roughly 17.4%. The underlying dynamic is clear. India tightens its capital requirements precisely as America loosens its own. To fully grasp the implications here, we have to dismantle the prevailing narrative about who actually benefits from this newfound balance sheet flexibility. This regulatory relief is not designed to stimulate local economies, and it certainly isn't aimed at Main Street businesses. It is carefully, surgically targeted at a very specific, highly constrained tier of the global financial ecosystem. The entities receiving this relief are heavily concentrated in custody, markets, and treasuries. We are looking at institutions like BNY Mellon, State Street, JPMorgan, Goldman Sachs, and Citi. These are globally systemic banks that dominate wholesale financial markets. Their primary focus remains squarely on optimizing their trading desks and managing sovereign debt, not expanding local lending operations. There is a documented historical precedent for this kind of selective, high-level easing. History repeatedly shows that systemic deregulation quietly removes the exact financial buffers that a stress event inevitably finds missing when it arrives. We saw this sequence play out flawlessly when the 2018 Dodd-Frank rollbacks directly paved the way for the institutional collapses we witnessed in 2023. None of these outcomes are accidents, and they aren't the result of unforeseen consequences either. When you synthesize all these data points, a very clear pattern of institutional behavior emerges. We are watching a well-established operational playbook run its course, a system that prioritizes structural liquidity above absolutely everything else. Consider the events of late 2019. Repo rates unexpectedly spiked to 10%, prompting a rapid $400 billion balance sheet expansion in just 5 months. Officially, that massive intervention was firmly labeled not QE. Today, we see an identical use of institutional language, with this current leverage ratio easing being smoothly masked under the phrase capital neutral. The cost of this system is borne quietly by the public. Think about the stark contrast here. $219 billion freed for institutions. Just 0.38% for savers? That's a negative 3% real return every year. The system is not broken. It is working exactly as designed. The founder of Voice on Pages has written a book called Stop Being Busy about recognizing structural extraction before it compounds. It is on Kindle, link below. Because in the end, capital doesn't have loyalty. It has logic.